And joining us now on the phone is Michael Pachter, Wedbush Managing Director. He's the biggest Netflix bear on the street with an underperform rating on the stock, a $125 price target. Mr. Pachter, great to have you with us. Let's just begin with your bearish call, shall we? What's at the epicenter of it?
Well, Jonathan, I actually raised my target to 150, so I don't want to have people think I'm too negative on Netflix.
I'll give you 25 back. It's okay.
My price target suggests that they'll be worth about $75 billion, and that means that they'll generate about 5% free cash flow return, so they'll get to about $3.7 billion of positive free cash flow. They're at negative $3 billion now, so that's a $6.5 billion turnaround. The street average price target says that they're going to have about a $13 billion turnaround. So I actually am acknowledging they're going to turn to positive, and they're going to get about half as high as the street thinks. But to get to the street number, they'd have to raise their price to $20 from an average of about 10 right now, and they'd have to get to about 200 million subscribers, which is about 50% growth. Those two things in a vacuum maybe could happen, but not in the face of competition. If Amazon stays at 11, Hulu stays at 11, Disney launches even at $15, it's going to be hard for Netflix to ask for more money from subscribers, especially as content dwindles. And if Netflix is able to develop its own content to replace all the content it's going to lose from Disney and Fox, it's going to pay up for that. So their costs are going to rise even faster than my competitors have modeled. I think my competitors are looking at subscribers, just as Paul Sweeney pointed out, and they're not looking at free cash flow. And unfortunately, I actually paid attention when I went to UCLA Business School, and they taught us that we value companies based on the discounted present value future cash flows. So cash flow matters. Apparently, investors don't care, and that's fine. But I do, because I'm a purist, and I actually think we have to be, loyal to the things that we were taught when we were young.
You are a purist, Michael, and I always appreciate you coming on this program and giving us a bit of insight, especially when the stock has done what it's done and your target price is where it is. When you communicate this to investors, how receptive are they to your story, your valuation?
In fairness, I think that I get paid more for being able to call quarters. I've covered Netflix for 14 years. This is my 57th quarterly call. I've been wrong twice. So investors pay attention to what I say is going to happen in the quarter, and I've been kind of remarkably consistent and right. They laugh sometimes at my long-term thesis, but surprisingly, more and more people are starting to warm up to it. The stock is starting to look kind of frothy, and I think there are a lot of investors who are going to consider taking profits when they think that that Disney's coming as a competitor. So pretty much everybody talks to me. Some think I'm an idiot, and that's fine. I don't really care. I care that investors make money. I've been joking with a big Netflix holder that I want him to hire me to captain his mega yacht when he retires on his Netflix profit. So I'll be fine with that.